American Advantage Law Group is proud to present this webinar for your viewing pleasure.
Loan modification, what it is and how to go about it. Loan modification is the amendment to the loan or changing the terms of the loan. This could include the re-amortization of the loan or changing the schedule of the payments for the remaining balance of the loan, the extension of terms in the loan in order to reduce payment of the interest rate, and or the loan balance so that the borrower can remain in the loan and the property. Who can qualify? The key word is change.
Sudden change in loan payments, in property value, in household income, in monthly expenses, or in debt can qualify. Also, illness or job loss, loan fraud, or reckless or predatory lending practices. What are the benefits of loan modification? First, you retain property ownership. The neighborhood values are also preserved. There's lower monthly payments, interest rate, and a principal balance potential reduction. Past due balances can be partially eliminated or completely eliminated or even deferred to the end of the loan. Additionally, there's no foreclosure ramifications. You keep your home and have a tax benefit, and you keep the future property appreciation. You and your family can stay in your own home. If you don't qualify for loan modification, there are alternatives. You can refinance into a new loan. You can short sale. You can get a qualified buyer to take over your mortgage. You can rent your home to someone to cover your payments, or you could find a roommate to share the house payment with you. It is important to note the alternative that you can go through the deed in lieu of foreclosure. As a last resort, you can give back your property in order to forgive the debt. Obviously, you will not save your house, but it won't be as damaging to your credit rating. However, you usually have to sell the home for its fair market value for at least 90 days before the lender will consider this option, and it may not be available if you have other liens such as creditor judgments or second mortgages against you. It does affect your credit rating just as much, however, so it's not preferable.
The process of loan modification is simple.
First, you gather all your documents. Then you create a financial statement and hardship letter. Calculate your DTI rotation. Prepare yourself psychologically and financially. Call your bank's loss and mitigation department. Remember to document all communication. And finally, close the deal. Gather all your documents from your mortgage statement, property tax, homeowners, flood, wind, earthquake insurance, car loan, and other loan statements, including your credit card statements. Remember to get your utility bills, your cell phone statements, your medical, dental, or life insurance statements, medical expenses, school tuition, bank statements, tax returns, W-2s, pay stubs, and other things that could potentially support your hardship. For instance, birth certificates, death certificates, medical bills, divorce papers, or bankruptcy papers, etc. The financial statement and hardship letter. Write a letter explaining the circumstances of your hardship, how and why you fell behind on the payments, and why you think that the loan modification process would be the best option for you and the lender. Calculating your DTI. Your current DTI ratio is the sum of your mortgages plus taxes plus homeowners insurance above your gross income. If it is above 45%, then your likelihood of completing a loan is good. If you have little or no income, then the DTI ratio is extremely high and your bank would pursue other methods. A bank's proposed DTI ratio is usually between 31 and 45%. IndyMac Bank is looking to modify loans at 38%, whereas Bank of America is looking to modify loans at around 34%. These differ from company to company, but between the 31% and the 45% is a good measure of what the proposed DTI ratio would look like if you were to get a good deal. Next, you must prepare yourself. This process is daunting. Psychologically, it's going to be difficult. The bank is going to look to get all of the money they can out of you, so do your best to prepare mentally and financially for the process. It could take anywhere between 4 and 8 weeks, so prepare 12 weeks to complete it. Remember to call your bank's loss mitigation department. This is going to be your main contact throughout the process. It's the part of the bank responsible for foreclosure. They will explain the documentation they need, so be prepared to fax multiple copies. In a couple of days, call them back and confirm that they have the paperwork that they required. Remember to document all communication. If you talk on the phone with the bank, write them down. Include the name of the person you spoke with and discuss. This is important if your application is rejected. Finally, close the deal. The bank may ask for a deposit up front, so be prepared to have the money. This process could take upwards of 12 weeks as mentioned before, especially if you are financially naive, so good luck. Here's an example of a loan modification. As you can see, the mortgage balance did not change, but the interest rate went down, as did the P&I statement. This led to a total savings of $9,504 in the annual lifetime of the loan and $256,608 in the life of the loan sum total, a 4% interest rate reduction. In our second example, this person is 5 months behind on their payments and has arrearages of $12,215 before the loan modification and an 8.5% interest. With a 2.5% interest rate reduction that became a fixed rate, there's $3,960 in annual savings and $102,960 in the savings for the lifetime of the loan. Frequently asked questions. If I'm in a foreclosure, can I still get a loan modification? Yes, if you can clearly show a sensible plan to the lender, you can still get a modification of the terms. Do I have to be behind payments to get a loan modification? No. Although lenders prefer you contact them before missing payments, if you do happen to, you can still get a loan modification, regardless or whether or not you have any sort of missed payments. Don't I need to have equity to get my lender to refinance me? A loan modification is different than a traditional refinance. Equity is not necessary. Don't I need to have good credit for the lender to work something out? Loan modifications are primarily for people who are just like you. You may just be starting to feel the hardship of an adjusted rate. You may have just had a hardship in the past which is now remedied. Lenders are willing to work with you if you can provide them with a plan that shows how they can get their money and how the loan is actually best for both parties. I have a first and second mortgage on my home. Can I get a loan modification? Yes, you can combine the first and second mortgage, or the lender may waive the second. What happens to late charges if my loan gets modified? Accrued late charges would be waived by the lender at the time of the loan modification. This concludes American Advantage Law Group's webinar. Call us if you have any questions. We wish you the best of luck.